Hey everyone, welcome back to Corporate Dakota, the place where we break down Wall Street's jargon for you. And in today's video, we are diving into International Seaways' latest quarterly report. And let me tell you, it's a tale of shifting tides and strategic moves that definitely kept the execs busy. Alright, so this is International Seaways' 10Q filing for the period ending June 30, 2025. Think of it as a mid-year checkup on the company's financial health. They operate a pretty massive fleet of ships, carrying oil and petroleum products all over the global market. It's a tough business, super sensitive to world events, oil prices, and how many ships are out there. Now let's jump straight into the numbers. The balance sheet gives us a snapshot of what they own and what they owe. As of June 30, 2025, their total assets were about $2.5 billion. That's down a bit from the end of 2024, which stood at around $2.6 billion. When we look at liabilities, total liabilities are down to about $623 million from $780 million at the end of last year. This is a really good sign showing they're managing their debt effectively. And look at retained earnings. They've grown significantly from $359 million to $406 million, which indicates they're making profits and reinvesting or holding onto them. Now, the income statement, this is where we see how much money they're making. For the 3 months ending June 30, 2025, they brought in about $196 million in shipping revenues. That might sound like a lot, but it's actually down from the $257 million they made in the same period last year. And that lower revenue directly impacted their bottom line. Net income for the quarter came in at about $62 million, a big drop from over $144 million in the same quarter of the previous year. That's a pretty substantial decrease. Looking at the first 6 months of the year, shipping revenues also dropped from $532 million in 2024 to $379 million in 2025, and net income followed suit, falling from $289 million in 2025. So revenues and profits are down significantly compared to last year. The cash flow statement tells us where the cash is coming from and going. For the first half of 2025, operating activities brought in about $56 million, again down from $324 million in the first half of 2024. Looking at investing activities, they spent a lot on vessels, about $101 million, which makes sense given their fleet expansion plans. Financing activities show a significant outflow of cash, over $2110 million in the first half of 2025, largely due to repaying debt and paying dividends. Speaking of dividends, they paid out $64 million in dividends in the first half of 2025, which shows their returning value to shareholders, but it also explains some of that cash outflow. They mentioned their fleet consists of 75 vessels and they have 6 new ships on order expected to deliver between the third quarter of 2025 and the third quarter of 2026. This fleet expansion is a big part of their strategy. The allowance for credit losses on their receivables decreased slightly, which is a minor positive, indicating fewer expected bad debts. This debt section is pretty crucial. It breaks down their various loans and lines of credit. The outstanding balance on their $500 million revolving credit facility is now only about $27 million in June 2025, down from $444 million at the end of 2024. That's a huge repayment. And even better, they fully repaid this facility in July 2025. This significantly strengthens their financial flexibility. They also had substantial lease financings like the Ocean Yield lease financing, which shows a balance of $266 million. It's interesting to note that this substantial balance is classified as a current liability due to certain contract clauses, even though the expected maturity is much later. This is a technical accounting detail, but it impacts how we see their short-term financial health. The number of outstanding shares is over 49 million, which is pretty consistent from the previous year. They've paid out significant dividends, almost $64 million in the first half of 2025. This is good for shareholders, but it does reduce their cash reserves. This explains how they recognize revenue, which is mostly from leases under a standard called ASC 840 SC 8042. Their pool revenues, which is a big chunk of their business, saw a considerable drop. For the first 6 months of 2025, pool revenues were about $286 million, down from $434 million in the same period of 2024. That's a nearly 34% drop. This section details their lease agreements like chartering in ships and leasing office space. The operating lease liabilities are in the tens of millions, and they've provided a clear breakdown of future payments. Now for the management's discussion and analysis. This is where the company talks about what happened and why. They start with a forward-looking statement disclaimer. Always important to read these risk factors because they give you a heads up on what could go wrong. They discuss global oil consumption and production figures. Global oil consumption is expected to increase slightly, which is generally good for shipping companies. However, they also point out geopolitical issues like attacks in the Red Sea impacting shipping. This is where they break down their performance by segment. The report states TCE revenues, which is a key measure for them, dropped about 25% in the second quarter and 30% for the first half of the year compared to 2024. This is the main reason for their lower profits. They attribute this mostly to lower average daily rates across their entire fleet. In their crude tanker segment, TCE revenues were down 18% for the quarter and 25% for the half. They mentioned selling a couple of VLCCs, which reduced their fleet size. And for product carriers, TCE revenues saw a larger drop, down 31% for the quarter and 34% for the half. This segment seems to be facing tougher market conditions. The average daily TCE rate for their VLCC fleet in the spot market dropped significantly from over $46,000 in the second quarter of 2024 to just under $40,000 in the same period of 2025. That's a big hit to their earning power per ship. Let's talk about liquidity. As of June 30, 2025, they had about $149 million in cash and over $560 million in undrawn credit. That's pretty healthy liquidity, especially after managing debt repayments. They're actively managing their capital. They've been selling older ships and using that money to reinvest in the fleet and pay down debt. They also mentioned upcoming dividend payments, showing a commitment to returning cash to shareholders. This table outlines their future obligations. Total commitments for vessel construction and betterments are substantial, around $301 million for 2026 alone, plus ongoing debt service. This highlights the capital-intensive nature of their business. Overall, International Seaways seems to be navigating a challenging shipping market. While their revenues and profits are down compared to a very strong 2024, they've made significant progress in managing their debt and maintaining a strong liquidity position. The ongoing fleet renewal with new builds and strategic vessel sales shows a forward-looking approach. The drop in TCR rates is concerning, and it will be key to watch if they can weather the current market conditions and achieve better rates as the year progresses. Their significant dividend payments are a positive for investors, but do reduce their cash buffer. The company's strategy appears sound, focusing on renewal and debt reduction, but the market's volatility remains the biggest risk. Alright, that's our deep dive into International Seaways' latest SEC filing. What do you think are the biggest takeaways from these numbers, and how will current geopolitical events impact their fleet? Let us know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more in-depth looks at corporate filings. And don't forget to join our Discord community. You'll find the link in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.